economic capital framework that is in the news recently. So what is the current affair thing? What is actually happening in recent times is recently Reserve Bank of India actually transferred a sum of around 2.11 lakh crore rupees to the government of India, to the union government. So that was actually the topic. That is how the topic is actually introduced. So why this RBI, Reserve Bank of India, is actually transferring that money according to one particular framework or an agreement. What that agreement or a framework is actually saying, meaning the word of that framework is actually called economic capital framework. So that is why we are going to understand or read about this particular topic. So this is actually one dividend, or the for example, RBI is earning a lot of money in a year. So after their basic purposes are completed, after they have to give salary to the staff and all, they have to do a lot of maintenance works and all these things. So after all those things are actually happening, there is a pending amount of money is there. So all those surplus money, that dividend money, is actually getting transferred to the government of India under an agreement that is called economic capital framework. So and this year we have to keep understand that last year it was around 87,000 crores rupees were actually transferred. This year it is actually about 2.11 lakh rupees, which means that around 140 percentage hike is actually not 87, it is somewhat more, but somewhat around 1 lakh crore. So now this year it is actually around 140 percentage of increase is actually there in the money which is actually transferred by the Reserve Bank of India to the government of India. So that is why the topic is actually extremely important, and we have to understand what this particular framework is actually all about. So what is this particular ECF or economic capital framework? It is actually one particular agreement or methodology or a system in which this particular money is transferred. And this Reserve Bank of India actually gets a lot of income, and they determine their profit. So they have a lot of expenditures also. So they, after that, they actually Reserve Bank of India is actually the manager of the union government. That is one important aspect you have to keep in mind before going into the topic. That is, the financial manager of the government of India is actually Reserve Bank. So after all their activities are done, they actually calculate their profits, and there will be a lot of risk provisions also. For example, some of the loans in which the banks actually give will be large, big loans and all, but that loans may have a possibility of default. So then at that times, all those risks should be assessed, and all that money should be taken and kept in a safe, and rest of the money and the salary of the staff and all this money have to be safely kept from the income, and rest of the money, rest of the profit, that is actually transferred to the government. So the note that the entire money which is actually got by the Reserve Bank is not transferred. So a sum of money is actually kept within the Reserve Bank of India itself. Why? Because of risk provisioning and all these things, to avoid that risk and other contingencies and all these things. Rest of the money is actually transferred to the government of India. And under which provision all these things are actually happening? It is actually happening on section 47 of Reserve Bank of India Act 1934. So you should also keep in mind that Reserve Bank of India was not established after independence. It was the pre-independence institution, and it was actually established in the 1930s based on the 1934 Act. And in the 1934 Act, there is one section that is actually called section 47. And in that section 47, it says that whatever profit, whatever balance of profit you have with your Reserve Bank of India, transfer it to Government of India. That provision is actually in the Reserve Bank of India Act section 47. So that section is actually extremely important in the RBI. So just like that, whenever you study about a legislation or an act or a law, etc., you don't have to study the entire law. Whatever provisions which are actually becoming important in the current affairs and all this, only those sections has to be studied. No need to understand about the different sections and by heart it in any document. And the next thing is that this particular document also mandates the Reserve Bank of India to maintain the contingency risk buffer, CRB, or the contingency risk buffer, in the ratio 5.5 to 6.5% of RBI's balance sheet. So for example, RBI has a balance sheet, right? The income and expenditure, just like that. So they have to maintain at least 5 to 5.5%. And the recent update is that they actually fixed the rate to 6.5. So 6.5% of the RBI's balance sheet has to be kept with the RBI. They cannot transfer to the Government of India. That have to be kept with the RBI, and that is called the contingency risk buffer. So what do you mean by contingency? For example, suddenly, for example, 2 years back, 3 years back, there was actually COVID, right? When the COVID-19 came, it was a contingency issue. There was actually financial issues where all the businesses were shut down. So those kind of events are actually called the contingency issues. All the financial issues, sudden issues, unprecedented issues. So when such issues happen, you have to have some sort of amount of money with you, with the RBI itself. So for that purposes, for that contingency issues, contingency risk buffer is actually also kept. That is also mentioned in the section 47 of the RBI Act. And what is the result of this particular transfer of money? So we said that RBI actually transferred that particular money under the in the economic framework actually. So what is the particular impact of this thing? So for example, government of India has a fiscal deficit, right? So in the economics you have to study about fiscal deficit and all these things, fiscal surplus, fiscal deficit and all these things. So currently the fiscal deficit of India is actually around 5.8% of the GDP, and we are actually, Indian government definitely wants to reduce the fiscal deficit of the Indian government. So ultimately, with this transfer of money, with this 2.11 lakh crores of money, when it comes, it is expected that the fiscal deficit will come down to around 0.2% reduction will happen. So that is one particular important impact of the economic framework actually, under which the money is actually being transferred. And this capital is, when this money is transferred, it is expected that our fiscal deficit will be reduced. And the next thing is that from where does the RBI gets all this money? What is the income source of RBI? That also has to be understood regarding on the sidelines of this particular issue. So one thing is actually about the open market operations. So what do you mean by open market operations? We can actually understand about the different bonds. So these are things are actually in the first two chapters of any economic textbook. You will understand what is a bond, what are the things to be, what are the things like that. So there are actually bonds. We also can actually buy bonds, such as government securities are there. We people can actually, common citizens can also buy those kind of securities and all these things. So bonds are actually available in the market, and what RBI does is that RBI can purchase or sell these kind of bonds. So whenever RBI needs money, what they help is that they sell bonds. And whenever RBI don't need money, they actually purchase this particular bond and sell this, give this money to the population. So these kind of things are actually happening. These kind of operations are called open market operations. And through these activities also, RBI is actually getting some amount of money. One thing. Next thing is that from the, when these bonds are actually being sold by the RBI and all, there is interest, just like loan amounts, just like credit amounts. Once we buy the loan, we have to give interest rate. So when the bonds are actually purchased, interests are actually being credited to the RBI. So that is one second thing. And the next thing is that forex, that is foreign exchanges. For example, RBI has a reserve of dollars and other currencies. They actually had trade in the currencies and all these things. So from that foreign currency assets also, a lot of returns are also coming. So that is another point. Next thing is actually about the lending of, for example, some of the banks might need some amount of money for short term. So these short term borrowings are actually given by the RBI to the small banks. From that interest also, RBI is actually gaining some amount of money. And all these things are actually happening. All these things are actually increasing in the recent times. So when all these things are actually increasing, which means that the income of RBI is also increasing, and that is why, one of the reasons why there is 140% of increase in the sum which is actually transferred to the government, which means that the income of the revenue of RBI is also increasing, because all these things are actually increasing itself. And the last thing is that you must be knowing about the repo rate and reverse repo rate in your economics class and all. So all these repo rate which has interest rates in a variable manner. So that is actually called the variable repo rate. So all these variable repo rate actually, that is VRR, variable repo rate, that is actually all are also happening. It is one of the reasons why RBI has more income in the recent time. So RBI has interest or income from different kind of things actually in the products in the market. And one important thing is the variable reverse repo rate auctions, in which the banks or the different financial institutions, it may be banks, maybe some other institutions, all these financial institutions actually pays variable amount of interest. For example, if that particular bank, after buying that particular bond of variable repo rate, that bank may be giving 1,000 rupees to the RBI in 1 month, but next month it is actually variable, it is not fixed. So next month the bank will be giving 1,500, next month it may be giving 500 only. So these kind of repo rates can be variable. That kind of bonds can also be issued by the Reserve Bank, and these kind of operations are actually done by the Reserve Bank, and ultimately they are getting a high number of revenue, high number of income is there, and that part of income is actually being sent to the government. So that is the topic that is actually called the economic capital framework, under which the section 47 of the RBI, under which all these things are actually happening.